head over now to Marcus Bogdan. We're going to get some thoughts on investment strategy. AGM season also underway. Where to find value? We've got Marcus Bogdan joining us from Blackmore Capital now. Marcus, pleasure to have you on the program. So far, I guess give us a bit of a summary of how you viewed AGM season, because we've had a couple of them.
Yes, we have. Good morning. The AGM season and also the first quarter updates have been encouraging. I think it's illustrative of the fact that we see that earnings and dividends have troughed in the FY20 earnings season, and then the AGMs, which we're seeing now, and the first quarter updates are just confirmation that we're seeing more upgrades than downgrades now, and that Australia is well placed to come into this recovery. And we really are at the first stages of the expansion phase in the economic cycle.
All right, so let's just look at the type of stocks that you're looking at, perhaps some cyclicals, for instance, where we are sitting right now, particularly obviously Australia, because it is a different story here, isn't it?
It is indeed, and so there are what we would call recovery plays, good quality recovery plays in the Australian market that are either cyclical or value based, and really have been left behind compared to other parts of the market. And some of those names that we like, the AGM update from Healius was particularly encouraging and has led to an upgrade in consensus earnings there. Strong tailwinds, 75% of the businesses is in pathology. They have had the benefit, obviously, of COVID testing, but even when you strip that out, the underlying numbers coming through for both pathology and diagnostics and day hospitals are all ahead of a year ago. And we see that there's value in that company. The valuation, it's trading on around 9 times EV to EBITDA, which is well below the offshore counterparts for pathology companies, which generally trade at 12 times. And the second thing that we are encouraged by is that it's sold an underperforming division, that's the medical centres, and it's now going to de-gear the balance sheet from around 2.7 times net debt to EBITDA to under 1 times. And so the company now, for the first time in many years, has got optionality in terms of its growth prospects and also capital returns.
The company has made it clear, though, that it expects the momentum to continue, that at least they've been seeing. And obviously, a vaccine is a panacea for a lot of the economy, but perhaps not for Healius. So just give us your views on that, how you sort of fight back against that.
Well, the impact of Victoria's shutdown has been absolutely real. I think we're starting to see Victoria coming out of that, and so I think the traditional parts of the business will start to recover, and you're already seeing that in more general pathology testing. You're seeing that in diagnostics, and you've seen a really big uplift in day hospitals where you've had a 34% increase there. So all of those trends, I think, are encouraging, and I don't think it's been fully reflected in the share price, and hence we believe that discount can narrow over time, especially when you see further evidence of execution.
Marcus, another one I know you're looking at is News Corp, which I find really interesting. What opportunities are you seeing there at the moment for the company?
Yeah, well, News Corp, you've had to be a very patient investor there. It's a classic holding company that trades at a discount. But I think in the last 12 months, you've really seen evidence there of the company wanting to simplify its corporate structure and really start to focus on narrowing that discount which it's traded at. And historically, it's traded at a 30% discount. And so there've been a number of levers that they've started to look at and to implement. The first one was a greater focus on divesting on sort of non-core or underperforming assets. News America was divested earlier this year. The second element is around Dow Jones, which holds the Wall Street Journal there. That business is now being separated out in terms of reporting, and that's a a highly profitable business. It earns around US 236 million EBITDA. And it's broadly a subscription business. 67% of its revenue is subscription. It's reoccurring, and the growth profile there, and if you compare that with something like the New York Times, does trade at a significant discount. And so, highlighting that division now that the market can get a good sense of what the growth opportunities there. And the final part, which hasn't occurred yet, but is probably the largest part, is that News Corp is the largest shareholder and the majority shareholder in REA, and that is an area where there is potential there with Move. There's a potential in-species spin-out of that company, and that would realise really deep value in the company. And that's the last part that really has to occur to achieve that narrowing of the discount. And hence, that's why we think there is an opportunity there. It's got some really good divisions there. The last quarterly update was ahead of market expectations, and so that's one that we are focused on in terms of a recovery play and understanding those catalysts to crystallise that discount.
Marcus, pleasure to have you on as always. Thanks so much for joining us with some of those investable ideas.
Thank you, Ingrid. Cheers.